Hey there, Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with the Market Misbehavior podcast is to sit down with top market practitioners, authors, educators, money managers, strategists, traders, brokers, anyone we can sit down with and talk about market conditions. We love talking particularly to people who have great insights, great lessons learned, great investment wisdom to share with all of you. And I'm very excited to share today's conversation. Today we're speaking with Jurrien Timmer. Jurrien is the Director of Global Macro at Fidelity Investments. I've known Jurrien for a number of years. He actually just celebrated 30 years at Fidelity. He was there before I arrived and has remained at Fidelity long after I departed the global headquarters in Boston. But at one point, Jurrien's office and my office were just about 3 doors down from one another. So I got to know Jurrien and his work quite a bit. You know, we started the conversation talking about his sort of journey through the financial industry and really most of the career at Fidelity, although he started in the fixed income side, which I did not remember earlier in his career. We talked about how fixed income investors tend to be so well versed in the language of risk, which can be very helpful in a very volatile year like 2025. So we talked about the fixed income markets. We talked about some of the indications and evidence he was monitoring to try to make sense of this crazy market environment. We talked about some of the things he's been writing about recently in his war report, his war plan that he shares with Fidelity money managers. Talked about the impacts of tariffs, as he called the tariff tantrum, and the recovery phase from early April to early May. We talked about the Trump put and how that early April low could end up being the low because the administration is basically demonstrating where their maximum pain point where they want to step in and take action. We talked about the potential for stagflation. We talked about small caps versus large caps, recessionary fears, and how that plays into your thinking. We talked about navigating short-term volatility as a long-term investor. And I think that is the type of question that someone like Jurrien is so great at helping you understand, because as individual investors, and if you work with individual investors, you're drawn into the short term because every little movement, every flickering tick elicits some emotional response, and your job is to either, deal with that in your own thinking or help a client deal with that in their thing. You're just trying to help people not to panic and make decisions based on evidence and not on emotion. Jurrien shared some great suggestions about how to do just that, how to focus on the long term, remembering that corrective market periods have usually presented incredibly good buying opportunities and some opportunities over time. I shared a chart or two that he has shared recently on social media, and I was able to ask him some questions about that, looking at long-term trends in the S&P 500, looking at valuations and where we are with a lot of growth sectors and growth stocks still aggressively overvalued by some traditional metrics. What I love about Jurrien, one of the comments he made was that the chart of the S&P 500 and the process of analyzing charts from a technical perspective is all about price discovery, and he'll explain what that phrase means. And I think it is a very well described way of using and leveraging the power of technical analysis. So please enjoy this recent conversation with Jurrien Timmer, the Director of Global Macro at Fidelity Investments. So I'm super thankful to be sitting down today with Jurrien Timmer. Jurrien is the Director of Global Macro at Fidelity Investments, usually based in Boston, today in Santa Barbara. But Jurrien, we used to sit a couple offices away from each other. Now we're a couple states away, but I am super appreciative of some time to catch up. So good to see you again.
Yeah, it's great to see you, David. And yes, we go way back, even within the hollowed halls of Fidelity. So it's good to see you, and I'm looking forward to the conversation.
No, it's a pleasure. And as we mentioned before we hit record here, there's so many things going on. I think so many different areas in the market we could try to talk through and review. Let's start with just a brief Jurrien Timmer origin story, because I'm super familiar with your work because I followed it for years in-house, and you've continued to share insights on social media pretty openly, which is great for everybody. Can you talk about your journey, particularly with mentors along the way? You've developed an incredibly robust analytical process looking at global different indicators and trying to triangulate them. what mentors or what sort of inspirations led you on this journey along the way?
Yeah, so I actually just celebrated my 30th anniversary at Fidelity. It's hard to
Wow.
believe 30 is such a big number. And so before Fidelity, I was in the business for 10 years in New York. I worked on Wall Street on a bond desk. And by the way,
Yeah.
knowing about how bonds and interest rates work is a really, really good base to then learn about other markets, because the interest rate side is woven into everything, right? But
Yeah.
but so then 30 years ago, I started Fidelity in the chart room, of course, which you know well. And
Yeah.
the last interview of the process was with Ned Johnson. And Ned, like nobody got to his chart room without his consent, right? And
That's
so
right.
we had a great meeting, and we just chatted about the markets. And next thing I know, I'm hired. And those early days, really absorbing the Fidelity culture, the whole
Mm.
Kaizen concept of slow and
Yeah.
steady improvements. And that's actually been kind of the story of my career. I used to try to outsmart the markets and be the guy who called this or that. And now it's like I just want to make small improvements over time. It's the law of compounding, but applied to careers or relationships or whatever. And
Yeah.
that concept was instilled in me by Ned in those early days 30 years ago. And so he was a very important mentor, whether he intended to be or not, or whether he even knew it or not. But going into that chart room, right, and looking at those 30-foot charts of the daily, Dow, S&P, Nasdaq, Russell, advanced decline line, and everything perfectly displayed with the semi-log scales and
Yeah.
museum lighting, and like it was really like going into a museum. And then just
Yeah.
seeing him do his magic, right, where he would put his finger on the chart and he would kind of bring it to the left and say, well, that looks like 1968, and then I would get like the oral history of what happened in 1968. And so I was just
Yeah.
absorbing this. So that was very important, but that was purely technical, right?
Yeah.
um, then as I got around, and you remember how well it still works that way, but if you're an analyst, you go around pitching ideas to portfolio managers to try to
Yeah.
help them create the alpha and the beta for our investors. And so in those early days, I had quite a bit of imposter syndrome of like, okay, I'm just like drawing lines on a chart here, and I'm going into these very important PM's offices, telling them I think rates are going up or the stock market's going down or what have you. And I felt like, they're used to dealing with earnings and valuations, and they're kicking the tires of companies. They're all doing bottom up stuff. And I was always a top down person. Of course, we
Yeah.
have bottom up technicians, very good ones, but that's not what I did. And so I learned fairly quickly that I needed to adapt and maybe reinvent myself a little bit to start speaking their language more. And that's how I went from being a technician to really a multidisciplinary analyst. And as you know, a chart is a chart. Like it doesn't matter what the chart is of. It could be of the PE ratio or earnings or what have you. And that was a very good move, I think, because it allowed me to create a more holistic approach to market analysis and to understanding what the narrative of the market is. I mean, at the end of the day, I'm just a storyteller, right? I'm telling the market story, I'm giving it a voice, and hopefully in the process helping investors to kind of understand what they need to pay attention to, even if there's no
Yeah.
easy answers like buy or sell. Like it's not really that simple. And the markets are like a multi-dimensional puzzle that basically can never be solved, right? You can get an edge, you can solve it a little bit, but then the ingredients change, and then you have to solve for that. And so, just trying to help people understand how the puzzle fits together was important. So that wasn't necessarily through mentorship, but just out of necessity. Like I'm a top down technician in a fundamental bottom up shop, and I need to adapt.
Yeah, no, and you found so many great ways you're in to become relevant, and I think still remain quite relevant to this day. Your war report, your monthly gathering of all the portfolio managers, is always well attended with great, thoughtful insights and questions. It's so funny. You're reminding me of one of the most stressful moments in my own career, which was doing the interview with Ned Johnson, which I also had that last interview. That was the most stressful, but also maybe most enjoyable
Yeah.
interview I've had because he was just a thoughtful, just knowledgeable, market expert. And I miss and also dread some of those chart room tours with the chairman. Those were always interesting,
Yeah,
right?
for sure.
But a lot of fun. So and again, thanks, Jurrien. I mean, I enjoyed sort of seeing how you continue to grow your impact within Fidelity, and now I think so many through your social media platforms are benefiting from your insights as well. So let's apply some of those insights to what we're seeing in the markets here today. 2025 has been an incredibly volatile year. I feel like investors that have been looking for answers seem to just get more and more questions along the way. Here we are recording this sort of early May. We've had a drop from the February market peak to a low in early April. The S&P recovering aggressively. Now the 200-day moving average, even today,
Mm-hmm.
sort of back in play. How do you sort of digest what we've experienced so far, and how, as a long-term investor, do you try to put that volatility into long-term context? How does that inform your positioning going forward, or how you approach market positions?
Yeah, so I think of all the price action as the never ending process of price discovery, right? So financial
Mm,
markets, whether it's stocks or bonds or what have you, they're always engaged in price discovery. And that price discovery, is efficient market theory, right? The market's not always right, but it's always anticipating and discounting all the known information, and that information can change, right? And then the price discovery takes another lurch forward. But that's how I
mhm.
view it, right? And so we had the election, of course, in November. The markets had been sitting on their hands for a while before the election because it was deemed too close to call. And then it was a pretty decisive outcome. And at that point, the markets priced in a fairly optimistic, playbook, if you will, of animal spirits, deregulation, extended tax cuts, and then the tariff, the T word was kind of like, well, it's a means to an end, but it's not the end. It's the art of the deal, this or that. And so the markets, boomed, and you had kind of the Trump trade, right? Small caps, higher yields, higher dollar, higher stock prices, and then by November, the S&P equal weighted index peaked out, and then by December the Mag 7 peaked out. And as
Yeah.
you know better than anyone, us technicians know that the price action doesn't lie, right? And so if something is supposed to happen and it's not, or the other way around, there should be like a little light bulb going off in our head. And then by January, that T word started to be used more, and the markets had to reprice a little bit because the markets really had not allowed for a left hill in that post-election
Mm,
playbook. Now they had
yeah.
to acknowledge that maybe there's a small left hill here where the growth story doesn't gets undermined by tariffs, etc. And then of course we had April 2nd, and we had that whole Liberation Day thing and some pretty kind of worst case scenario tariff talk, at least from the eyes of the markets. And then a bigger left till had to be accounted for, right? So I think of it as you run a store, you sell bicycles, and nobody wants to buy them. Well, you put them on sale, right? You take 10% off, and if that doesn't work, you go 20% off, and that's how the price
Yeah.
discovery works, right? The market went from all-time highs in December to down 10%, and you see it on that chart there, right there. And 10%, of course, is nothing, right? I mean, the market spends 40% of its time down, at least down 10%. So that's kind of
Mm,
relatively normal, but that was your 10% off sale right there. And then we had a little
yeah.
rally, as you always do. and then you had the whoosh, right? And that was the April 2nd to April 8th, that window when all those reciprocal tariffs came out, and that's your 20% off sale. And we were down 21.5% at the low. And then you go
Yep.
back to the scene of the crime, right, which is that pink line. I mean, you've seen this movie over and over. And initially, it fails. Exactly what happened there. That's where the sellers come out, or where the stops were triggered the first time around, so people can get out, but while staying whole. And then you go back down, and you had a retracement about 50%. It looks like sometimes you have a double bottom, like we had in '98. Sometimes you just keep going, like some of the really big bear markets. But this is a really elegant way of just showing how all that buying and selling and that sentiment works out in a single chart. Like, it really does tell the whole story. And then we went back a second time to the scene of the crime, and now we took it out. And now we're
Yeah.
much higher. We're at the 200-day moving average. Bitcoin is already above 100,000, which is kind of a risk-on barometer. And so now you have to think about, okay, are we now building a larger range? Are we going to go off to the races like we did in 2018, for instance? And we don't know the answer yet, of course. But to me, that's how I think about the price action. It's 24/7 price discovery, and the price discovery in the market happens a lot faster than you or I can adjust our portfolio. And that's why you either have to kind of stay away from it and just let this thing go and use volatility to rebalance, right? So if you're in a portfolio,
Mm.
you're in a 60/40, and all of a sudden the markets move and that 60/40 becomes 50/50, you can do something about it by making it back to 60/40. So you're buying equities, you're selling bonds, or whatever the building blocks are. Or if you want to be really proactive, you need to be positioned before the price changes. And that, of course, is very difficult because you can be really early, which is no different than being wrong. But that's the challenge in being an active trader or investor. You are up against trillions of dollars, and I think of the price charts as the collective unconscious of every person who's ever traded anything, right?
Yeah.
And so that's why over the years I've become less inclined to try to outsmart the market, and just more inclined to try to have a more strategic view, and then to use these bouts of volatility to basically to rebalance. And as you well know, at Fidelity, we're very large, of course, and we tend to be very long-term investors. And I actually still remember many years ago going into the then portfolio manager of the Magellan Fund, saying, "Oh my God, I think the market's going to correct 10%." And he said, "Good, then I can buy more," right? And so that taught me that it's better to be a provider of liquidity than a taker of liquidity, right? And so
True.
all of these things are mindsets that I think smart investors can use.
I will never forget, and I forget what pullback that was in like the early 2010s, and it might have been around the financial crisis coming out of that. But I remember one of our former colleagues was so excited, like he was excited about the market pulling back, and I was going into his office, and I thought he would be absolutely
Yeah,
despondent because things had pulled back, and he was like, it's like getting a 20% off
yeah,
coupon
exactly.
for awesome
Yeah,
companies. Like, this is
yeah.
fantastic. And that has stuck with me for sure. So do you think, I mean, just looking at how the markets have played out, obviously there's a lot of volatility, still a ton of headline risk, but still, even with the S&P rebounding from what 4800 and change up to 5500 plus, now almost 5750, people are still sort of waiting for the next shoe to drop and the next rotation lower. Do you think we've now found where that Trump put level is? Have we now defined the lower end of the range in 2025 with that April low? And what sort of gives you the confidence to say that that's true or not?
Yeah, and that, and again, as these cycles unfold, whether it's a bullish cycle or a bearish one, and we don't know yet if this is a bear market or a bear scare. I mean, we've been down 20% before, and nobody thinks of it as a bear market, because bear markets require, I think, both time and price, right? So a
Mm,
20% haircut that lasts 3 days, does not have that time element. But a 20% haircut that lasts 9 months, that's a bear market, right? So we don't quite know yet. But one of the important signals that we've learned, right, as this new cycle unfolds, especially in the current climate where it was said by the administration early on, like, we're willing to let stocks go down. That's the price to be paid for change, but we're really focused on the 10-year yield, right? And that's certainly a change from the first term, right, back in 2016 to 2020, where it was all about the Dow Jones and nobody ever mentioned the 10-year yield. So it's a different world. And then we had that swoon, or we had that kind of chaos in the 10-year when that basis trade was unwound. This is back in March, and the yield went shot up 50, 60 basis points in a matter of days. That got the attention of the Treasury Secretary, and some of the rhetoric was pulled back to allow the bond market to settle. So, again, I mentioned I started my career in the bond market. I mean, the bond market has a lot to say about everything, and if you will remember that back in the old Clinton days, James Carville famously said that if he could ever come back to life in a reincarnated state, he would come back as the bond market, because the bond market, no one is more powerful than the bond market, and we learned that a month or so ago, because that was the first put. And again, we're used to having a Fed put, but there is no Fed put right now, right? Because it's not clear whether we will get a recession or a slowdown, and what happens to the inflation side with tariffs. So I think the Fed is rightly kind of sitting on its hands here. It gave us 100 basis points last year. It's marginally above neutral in my view, right? If neutral is inflation plus 1%, that's about 4%, and the Fed's at 4 3/8. So the Fed, is not too restrictive, and it's not too accommodative. So the put has gone from the Fed, now still in the bond market, but to the Treasury, to the fiscal side of the house. And then, of course, a week later, I think it was, when the S&P swooned, 20%, that was the other put. So we have a sense now of where the put is from the interest rate side and from the equity side. I don't think there's a put on the dollar side. I don't think anyone minds that the dollar is weaker. And so that is, again, a helpful evolution of the price discovery process. Like before we knew that there was a put and at what level there was a put, the markets are just kind of doing their thing without knowing where the guardrails are. And now that we kind of know, that's very helpful, because it gives you a sense of, okay, these are the goalposts, that's the red zone, and it helps the markets sort of mean revert within those ranges. And so I think that's part of the evolution of price discovery.
It's so many. I mean, there's so many great things to unpack in there, and you've mentioned your experience, your background in the fixed income markets, and I remember, again, from my time at Fidelity, having an opportunity to talk to the high yield guys, go up to Merrimack and talk to the fixed income desk. You saw how much, and I know from some of our equity analysts that had started in the fixed income side, they were just so much better at assessing potential risks, whereas the equity investors were so much focused on potential rewards. And I feel like the bond markets are always so good at defining, potential risk, which, and a lot of the times is really the game, is sort of recognizing that.
Yeah, and if you think about it, right, the equity side is focused more on the income statement, and the credit analysts are focused more on the balance sheet. And if there is a balance sheet recession like we had during the financial crisis, that's where the signal comes from. I mean, they're not all balance sheet recessions. Sometimes there are income recessions, but so it's very important. And this is where the intermarket dynamics come in, right? When I look at the drawdown in the S&P, I'm putting that side by side with what credit spreads are doing. And if the S&P recovers from the abyss, while credit spreads do not, that is a sign, or it's potentially a sign. And so as the market came back from the abyss, last month, credit spreads have moved in lockstep with that. And that, to me, is a healthy sign that the bond market doesn't see something nefarious that the stock market doesn't see.
Yeah, right. So one more question then. Talk to me a little bit about valuations. This was a chart that you shared on social media here recently, which is looking at the CAPE ratio, and I guess the challenge to the market just recovers from here thesis is all those concerns we have about valuations not too long ago. It's not like things really got enough of a discount valuation wise, arguably. What do you see in terms of how valuations are sitting now through the volatility? What does that mean for long-term prospects? How does that relate to other things that you're observing?
Yeah, no, it's a great question, and one of the things that makes the current cycle uh, particularly high stakes, let me put it that way, is that the bull market that started in October of 2022. It may or may not have ended in February of 2025. We just don't know. That this 20% could just be a bump in the road. We just don't know yet. But that February 2025 is 30 months after October 2022. The median length of a cyclical bull market going back 150 years is 30 months. Now, that median, of course, is a median of a widely dispersed data set, but still,
Yeah.
it's not 10 months. And so you get into the thinking, okay, this thing is actually kind of in the eighth inning potentially. And at the same time, the secular trend, right? So these are the super cycles, which you see here. By my measure, the secular bull market started in '09. I know many technicians do not agree with that. They think it started in 13 when the old highs were taken out. I see it
Sure.
as it started in '09 and it was confirmed in 13. But either way, but so by that measure, if a secular bull market on average lasts 18 years, we're at year 16, right? And so from my
Yeah.
perspective, that secular wave might be cresting at the same time that the cycle is also potentially cresting. And so then you start to think about, okay, what are the attributes that made this secular bull market a secular bull market? And you can see right there in the chart, it's margins, right? That's the green shading. So
Yeah.
margins were like 6% in '09. They're 13% now. Uh, the PE is a measure of that success, right? You can see how closely correlated they are. Of course, we talk about the Mag 7, the mega cap growers. Their dominance is part of that story. The amount of shares they buy back, that financial engineering component, that's part of the story. All of these things have to do with each other, and and it looks like the PE has now double topped. At least this is the 5 year cyclically adjusted PE. I like to use a 5 year as opposed to a 10 year because a 5 year it kind of measures one cycle.
Yeah.
So to me, I don't see, even if the 20% was just a scare and not a bear market, I don't see another vertical lift like we had last year, right? So this cyclical bull, 30 months old, 2023, the first year of the bull, earnings actually fell very slightly. So that was all
Mm,
PE driven, and it was all the Mag 7, right? The broader market did not participate that year. Then in
yeah.
24, you did have the participation, but still with that dominance from the Mag 7. But then you had 12% earnings growth, greatly amplified by PE expansion. Um, that I think is very hard to repeat in 2025. A, because the P is already up there even after this decline, and B, earnings growth has likely peaked, and you can see the estimates are now coming down as analysts are pricing in the effects from potentially a trade war. So I think 2025 may look a lot like 2018, actually, where you had earnings
Mm.
growth but you had PE compression sort of offsetting that. And there's plenty of opportunities there, but they're more going to be on the alpha side than on the beta side, right? With the beta being the market return and the alpha being the excess return that we can generate from being in the right sectors or regions or what have you.
Arguably a decent opportunity for stock pickers,
Yes,
right? Hopefully, we all agree on that. I would
for
hope.
sure.
Jurrien, this has been such a pleasure. I mean, great to see you again, and not surprisingly, your insights and your expertise really shine in a short conversation. really appreciate what you do to educate investors and elevate the level of discourse on social media. You do a really good job putting out some thoughtful content, and I hope it encourages people to make better decisions. But Jurrien, great to see you again. I hope we can continue the conversation later this year.
Thank you. It's a pleasure, and it's great to see you, David.
What a great conversation. Again, thanks again to Jurrien Timmer, the team at Fidelity, for giving us some time today. I could have gone on for hours talking with Jurrien about different market periods. I mean, he is a market historian, a market practitioner, and just a wealth of experience and insights. I mean, just some great experience, 30 years at Fidelity, navigating so many different market environments. And I think, having someone like him share how they're navigating a market like 2025, really refreshing, and I think reinforces some of the basic premises that I hope we talk about often with market misbehavior. I love that phrase, price discovery, and I remember him using it back in the day, following his work more closely. And I really love how you think of charts, you think of the visual evidence as telling a story. It's just really trying to unpack the nuances of where we're at, and using the visual forms of analysis, the technical analysis tools, to really quantify investor psychology and understand where we're at relative to where we've been. Jurrien does a great job sharing historical analogs, talking about where we're at, sort of a "you are here" marker compared to previous market cycles. And I think his comments recently looking at years like 2018 and how that could relate to 2025, I think were really well said. You can follow Jurrien's work on social media. We'll put links anywhere you're watching or listening to this podcast. You can follow him on X. He has a wide following, and with good reason. We talked off camera before we started about elevating the discourse of financial analysis. The great thing about the social media environment in 2025 is there's very low barriers to entry. And in some ways, that's great. I love the fact that younger, less experienced investors have the opportunity to interact with people like Jurrien, who have great experience and so much to share to help you grow as an investor. But there's a downside to that, which means there's a lot of noise out there. And there are a lot of people sharing charts and ideas that don't really have the experience or the ethical standards that they're abiding by that really validates, I think, a lot of the things that they're saying. And I think when you look at what Jurrien shares openly on social media, I mean, there's just great wisdom and expertise behind each of those visualizations. So thanks again to Jurrien Timmer. Thanks for reminding me about the benefits of price discovery and going through all of our questions about all the different market conditions here in 2025. By the way, if you want to improve your own capabilities in analyzing the markets, discovering price in your own process using the tools of technical analysis and behavioral finance, I hope you'll consider our Market Misbehavior Premium memberships. This is where we take a smaller subset of our community and really help them improve their decision making. 3 great benefits to the premium membership. Number 1, access to all of our virtual courses. We have courses that will teach you about technical analysis, about behavioral biases, about developing good routines and consistent decision making processes. Second would be access to our members-only reports, like our weekly flight plan. That is my main report that I put out every week. And also our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and different asset allocation themes. Finally, you will have full and immediate access to our members-only community. We have a great growing community of like-minded investors where you can ask questions, you can learn from others and their own experiences, you can share charts and ideas, and I'm there every day answering questions and nudging people in the right direction. So if that's of interest and you want to learn more about it, just go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. A reminder, that's marketmisbehavior.com/premium. That'll do it for today's episode. Thank you so much for watching and listening. If you have suggestions on other experts we can bring on to have this kind of conversation with, we're always open to new people and new ideas. So drop a comment wherever you're watching this, and we'll make sure we take a look. For Market Misbehavior, I'm Dave Keller, reminding you it is always a good time to own good charts.